If you have $800,000 sitting in a traditional IRA, you are probably resigned to watching the IRS take a cut, maybe 20%, maybe 30%, every time you touch that money. Most financial advisors will tell you that's just the cost of doing business. They're wrong. There is a specific legal way to pull money out of that account year after year until every single dollar is gone without owing the IRS a single cent in federal income tax. No loopholes, no gray areas, just a handful of tax rules already sitting in the code waiting to be stacked together. And this works even if every dollar of that $800,000 is locked inside one traditional IRA.
The standard deduction and the bridge years. Let's start with strategy number 1, the standard deduction, because this is the one that works no matter how your money's split up. If every single dollar of that $800,000 is sitting in one traditional IRA with nothing else diversified, this is your primary weapon, so stay with me here. The IRS hands every retiree a standard deduction before it calculates a single dollar of tax. For 2026, a single filer aged 65 or older gets $18,150 of that deduction. If you're married and both of you qualify, that number jumps to $35,500. And this year, there's actually a bit more on top of that. A temporary senior bonus deduction worth up to $6,000 if you're single or $12,000 if you're married, on top of everything else, as long as your income falls under the threshold. Now, let's address the obvious math problem, because you're probably already doing it in your head. If you only pull $18,150 a year out of an $800,000 account, it's going to take you over 40 years to empty it, and that's assuming the market doesn't grow a single dollar in the meantime. That's not emptying the account. That's letting it grow into a bigger tax bomb for later, right around the time required minimum distributions kick in at age 73 and force your hand anyway. Here's the fix. It's called the bridge years, the window of time after you retire but before you start collecting Social Security or hit that RMD age. During these years, your reported income is at a lifetime low because there's no paycheck and no forced withdrawal yet. So here's the move. You pull your standard deduction out of the IRA tax-free, and in that same year, while your income is still low, you convert another chunk of that IRA into a Roth inside the 10% and 12% tax brackets. You're not waiting for the IRS to force your hand at RMD age when the account has grown even bigger and the tax bill is even worse. You're moving money out on your terms, at rates so low they're barely a rounding error. One quick note before we move on, because this matters. We're talking about wiping out your federal tax bill here. Your state is a separate conversation, so double-check your specific state's rules before you assume zero means zero across the board, because Uncle Sam isn't the only one who wants a cut. The standard deduction and the bridge years conversion handle the IRA directly. Now, if you don't have a taxable brokerage account, don't tune out here. You still need to understand how this next bracket works, because we're going to use these exact same limits to run your Roth conversion in strategy number 5. The 0% capital gains bracket. Strategy number 2 lives inside the 0% capital gains bracket, and it applies to any money you've got sitting in a regular brokerage account outside the IRA. The tax code sets aside an entire bracket where long-term capital gains get taxed at 0% as long as your total taxable income for the year stays under a specific line. And here's the part that actually matters for what we're building. This bracket works right alongside the standard deduction, so your IRA withdrawal and your brokerage account sales can sit in the same tax year without pushing you out of that 0% zone. If you've got a brokerage account, this is how you fund real spending, groceries, travel, whatever life actually costs, completely tax-free. And every dollar of spending you cover this way is a dollar you don't have to pull out of the IRA, which means more room left over to run a bigger Roth conversion in that same year. Between the standard deduction and the 0% capital gains bracket, that's spending covered without adding a single dollar of taxable income. The next doorway works the same way, just for a different account. Roth IRA Contributions. Strategy number 3 applies if you've also got a Roth IRA, and it has nothing to do with waiting until age 59 and a half. Every dollar you originally contributed to a Roth IRA can be pulled back out, at any age, with zero tax and zero penalty. That's because the IRS treats Roth withdrawals in a specific order. Your contributions come out first, and that money was already taxed years ago. It comes out completely clean. That's different from the account's earnings, which follow their own separate rules. A lot of retirees confuse contributions with earnings, and that confusion is exactly what keeps them from touching this money out of fear. Know the difference, and you've got another clean, tax-free way to fund your life, without touching the IRA and without touching your reported income. That covers spending funded from outside the IRA. There's one more account built for exactly this job, and most retirees only ever use it for one thing: the HSA Triple Tax Break. Strategy number 4 comes from the one account the IRS gives a triple tax break to, the HSA, if you've got one. Money going in is tax-free, it grows tax-free, and coming back out for medical costs, it's tax-free too. That's not something any other account in the entire tax code can claim. Here's the part most people miss. Old medical receipts, the ones sitting in a shoebox or a drawer from years ago, can be reimbursed at any point in the future. That medical bill from 3 years ago can turn into a tax-free withdrawal today. Reimbursing real medical costs this way, instead of pulling that money from the IRA, keeps your reported income at virtually zero and protects the runway for that year's conversion. Each of these doorways works on its own, and not everyone has all 4. But none of them are actually the main event. They're what keeps your reported income low enough for the move that actually matters. What stacking really means. Strategy number 5 isn't a new account. It's what stacking actually means, and it's the piece that ties everything together. Stacking doesn't mean you're pulling $50,000 directly out of the IRA tax-free. It means you're pulling $18,150 tax-free out of the IRA using the Standard Deduction. Then you're funding the rest of your year's spending using tax-free capital gains, Roth contributions, and HSA reimbursements. All of that keeps your reported taxable income sitting at virtually zero. And because your reported income is at zero, you've opened up a massive, clean runway inside the lowest tax brackets. That runway is exactly where you run a bigger Roth conversion out of the pre-tax IRA for a fraction of what it would otherwise cost you. Repeat this every single year: the tax-free Standard Deduction withdrawal, the tax-free lifestyle funding, and a Roth conversion inside the low brackets. That's what actually walks an $800,000 IRA towards zero without tripping IRMA surcharges, without triggering Social Security taxation, and without ever jumping into a higher bracket than you need to. So here's the whole thing tied together. An $800,000 traditional IRA doesn't have to turn into a tax bomb. Use the bridge years, stack the Standard Deduction with whatever else you've got, brokerage, Roth, HSA, and you turn that account into a structured, repeatable drawdown at the lowest legal tax cost instead of one massive bill later. If you want to go deeper on protecting your retirement income from unnecessary taxes, that's exactly what the next video on this channel covers. Go check it out.